Okay, so this is such a nice relaxing section on contributions. The main thing you need to know about contributions is that they do need to be recorded. Just because the town gives a company a $100,000 piece of land to get them to come to our community and provide all the jobs and tax revenues that far into the future, we cannot just say, oh, it didn't cost us anything, we'll forget about it. No, it has to come on the books. So how do we do this? Oh, these are called non-reciprocal transfers. Assets are just coming in one direction with nothing going out in return. Using the term non-reciprocal transfer, that's why you get paid a little more as an accountant rather than to say it's a contribution. All right. You can use a fair value of the asset or, lacking that, an appraised price. And this is what it would look like. If the company were given some land to move to a certain neighborhood, they'd book the land at its fair market value, and they would book contribution revenue, okay? This would go on their income statement, you know, other revenues and gains, and taxes would be paid on that, and so that revenue, according to FASB, needs to be booked. Okay, so what if the company donates an asset? In that case, they're going to have a contribution expense. So say the company has an extra piece of land and they donate it to the town for a park. Well, if the land's on the books, if it's $50,000 on the books, but the fair value of that land is now $60,000, they're actually going to have to take a gain on the disposal. Okay, so that's your contribution revenue, contribution expense, has to be recorded. Okay, now they just briefly mentioned the prudent cost concept. If a company overpays for an asset, it should record a loss on the purchase. If it underpays, it gets a bargain, they don't record any gain. Just good to know. All right, so that takes care of our easy section on contributions, and we'll move on to costs subsequent to acquisition, which aren't really that bad either.